Good morning, everyone. On this Sunday morning, I welcome all the participants to the Valuation Manthan session 19, Enterprise Value on Acquisitions. Once again, on this Sunday morning, this Valuation Manthan is a great initiative of Valuation Standard Boards of ICAI under the leadership of its chairman, CA Hansraj Chugji, and its vice chairman, CA Priti Paras Saulaji, for the benefit of all the existing as well as aspiring registered valuers. Due to some commitments, our chairman and vice chairman is not available right now. So I will, with a brief introduction of our speaker today, CA Ushma Shah, will start this session. The session is on valuation, enterprise value of acquisition. CA Ushma ji is a partner with Mrs. Bansi S. Mehta and Company, a leading firm of chartered accountants in Mumbai. She is a chartered accountant with over 10 years of experience, and she is also a registered valuer under the Companies Act 2013. Her work profile includes a rich blend of experience in transaction advisory, including business valuations, valuations of intangibles, advisory in the field of mergers, acquisitions, spin-offs, restructuring, financial modeling, etc. She has carried out several valuations for recommendation of fair ratio of allotment based on fair valuation of equity shares of companies or divisions for amalgamations, demergers, etc. for various listed as well as unlisted companies. Valuation of businesses and intangible assets for the purpose of its transfer and for internal assessments, open offers, FEMA, transfer pricing studies. Valuation of various instruments and cash generating units for accounting purposes. With this brief introduction, I request CA Ushma ji to start today's session.
Yeah, hello. Good evening. Good morning, everyone. Thank you, CA Anisa, for the introduction. I will just give me a moment. I'll share my screen. Yes, first of all, thank you for the opportunity given to me, as well as for sparing a Sunday morning, especially on a long weekend. So let's start towards this very interesting topic, enterprise value for acquisitions. So now we know that mergers and acquisitions are an important part of the corporate world. My screen is visible, right, ma'am?
Yes, ma'am, it's visible. Yeah.
Oh. Yeah, so we all know that mergers and acquisitions are an important part of the corporate world. As the Greek philosopher had once said, that change is the only constant. As the economy evolves, decisions and businesses that once made sense no longer do. The best example for this, or rather one of the examples for this would be, say, Kodak. Kodak, we all know, was a market leader in photographic films, and we know how it struggled when the industry transitioned to digital photography. We are also well aware of phasing out of Nokia handsets, a one-time market leader. So these are just a couple of examples on how pertinent it is to remain relevant. So a company that had invented a groundbreaking innovation may not necessarily be the best one to exploit it to its full potential. So that we can say is one of the major reasons why we see so many deals in the startup space as well, as a particular set of entrepreneurs may be better suited to harness a type of business compared to others. So, okay. So let's look at a couple of acquisitions. Of course, we all know when the bird was freed, and now, in fact, the bird has not only freed, but it has flied away, and now we have X. So when Elon Musk took over Twitter, also when Zomato made an acquisition of Grofers, also called Blinkit, it was an expansion for Zomato to expand in the food arena when it took over the quick e-commerce giant Blinkit. The deal was for around 4,400 crores. Of course, one of the most talked about deals in the airline space when the Maharaja returned home, when after the nationalization of Indian Airlines, when a year back, Air India was again acquired by Tata Sons. We are also well aware that, the Walmart buying a controlling stake in Flipkart at least threatened Amazon. And when Microsoft struck a deal with Activision, though the deal is currently under scanner and may or may not receive approvals because of the Competition Commission equivalent in US. But the business acquisitions, of course, are a very interesting topic, and they drive attention from people all over the globe. So when first of all, to start with, what is a business acquisition? Now, different dictionaries define business acquisition, but as you and I both understand, it is defined as a corporate transaction where one company acquires a part or portion of other companies' assets or shares. A business combination typically is effected in yeah, it can be affected in multiple ways. It can be buyout by its own managers. It can be buyout by outside investors. It can be lenders, a leverage buyout, whereas lenders have converted their debt into borrowings. Also, it can be effectuated by, say, a merger or an amalgamation, which are an NCLT scheme, or say for a listed company, it is just simple purchase out of shares, and pursuant to that, there is an open offer or a tender offer. It could be an all stock deal, or it could be just acquisition of a particular business, like how under the Income Tax Act, we call it as the slump sale. It could be by way of a business transfer agreement, or it could be under Section 232, 232 of the Companies Act pursuant to an NCLT scheme. So there are multiple ways in which an acquisition can be effectuated. It could be a simple small acquisition for a big conglomerate, or it could be a very it could be coming together of two equivalents. But whatever kind of acquisition it may be, it is always quite interesting. So moving on, and to start with, there are multiple ways in which, okay, we discussed the multiple ways in which an acquisition can be effectuated. Moving on to this, how does an acquisition typically start? First of all, every company would have a strategy, and the acquisition would stem out of a strategic rationale for the acquisition. The strategic rationale could be such as improving performance of target companies. So what are listed here are a couple of archetypes which have been identified by McKinsey in its books. It's not so these strategic initiatives are not concepts like only growth or strategic positioning, but they are much more detailed. For example, let's look at improving performance of target company. Now, when a target company, say for example, has a PAT margin of say 2% and a return of equity of say 1%, it is much easier to improve its performance compared to a company whose PAT margin is say 15%, which is equivalent to the industry norm of 15%, and it already has a good ROE. So improving performance of the target companies could be one of the most important strategic rationales for acquisition. Then the other archetype which it specifies is to identify winners early and contribute to their growth stories. Of course, most of the startup acquisitions, especially by conglomerates, would fall under this category, where they want to identify the early movers or the winners early, and then invest in them and grow with them while generating returns. Creating market access for the products or services of target company. This, as the name suggests, is so. For example, we have a company, we have a bank, and the bank starts a acquires a broking company. It knows that it has the possibility to cross sell the broking services to its existing clients. So creating market access for products or services of target company, acquisition of a skill or technology easily instead of time and cost commitments for building it. Now, a good example in this case would be acquisition of Siri. We all know Siri used by the iPhone. So acquisition. So Siri was in fact acquired early on by Apple. Similarly, this is very common in the tech space where deals keep happening and a skill or technology is acquired so that instead of the time and cost commitments involved for building it, the acquirer also has an early mover advantage. Consolidation of overall market. This we see as industries mature. There could be consolidation in the overall market to remove the excess capacity from the industry. For example, so this is quite common when an industry matures. So rather than a small company shutting down one of its plants, the industry may find it beneficial to come together and then shut down a particular unit because it still would remain bigger. So that is the mindset typically for consolidation of overall market to remove excess capacity from industry. And of course, exploiting an business or industry specific scalability. Okay, here when we talk about identifying winners early, I would also just like to mention here that many conglomerates, especially in this startup phase that the country is in, have specific cells which identify and which try to identify the startups and no, which they feel would be the winners and would have a good growth story and effectively grow with them. Okay. So once a rationale
Hi,
is
Ushma, good morning. Presentation is there?
yes,
Yeah, you have started, no?
yes, hi
Yeah.
ma'am.
Yeah, hi.
Hi.
Okay, please go on. Yeah.
Yes. So okay, so to start with, once a strategic rationale has been identified, it is then there comes it is important to analyze what is the motive uh, behind which the acquisition is made. This is important even when we are doing valuation, as it would help us to make the relevant changes or modifications to the value of the business as the deal may command. The motivation for an acquisition can broadly be categorized into these four categories. One is that we feel that the target is undervalued. This is one of the most common reasons for an acquisition. And if one feels that the target company is valued at a value lower than its fair value, and by acquiring it at that particular value, one could have higher growth for its stakeholders. This they also or this is also typically called the value investor mindset. There could be some challenges here as to identification of undervalued company and to ensure, suppose in case it is a listed entity, that it remains undervalued till the deal goes through. Or because sometimes what happens is that while the deal is going through, the market price of the target increases. So that is the undervaluation motive for an acquisition. Coming to the growth motive, this, as the name suggests, is mainly with the intention of synergy, of growing together, and this could be backward integration or forward integration. Control aspiration. This usually typically stems from the belief that target company is not managed optimally, and there is a possibility of improving the business by changing the management or their policies. So post acquisition, there could be a management change and there could be a further control. So these could even be cases where it is an acquisition of, say, the vendor, where one ensures that there is backward integration and also a greater quality control. So this would fall under the control aspiration. And of course, the last motive being managerial self-interest is basically one can say to an ego battle or to meet milestones, that for it to be, say, the largest company with that particular capacity in the country, or to have a legacy, or for personal motives basically. So this is typically a motivation. So how it starts with this: once there is a rationale, then the motive is established, then the various parameters are evaluated, a market search is conducted, a target is identified, then one initiates talks with the target. At this stage, one would have a rough back of the envelope uh, working in mind as to how is the target performing, and at what would be a good buy. Uh, of course, going forward, then there would be a detailed due diligence exercise. This would be a financial due diligence, as well as tax, indirect tax, as well as operational due diligence, to ensure that things are in order and the ethos and policies of the companies match, and the financials, especially if they are provisional financials, do reflect the correct picture of, and the acquirer is not overpaying. Okay. After that, there are negotiations and valuation, where comes the most important part. And of course, after that is the deal closure, which would include, other than the signing, the NCLT process, etc. So if the acquirer could easily build an business from scratch without significant overheads, they are likely to attach a low value to the seller's company. So why would they pay a premium to acquire it? Instead, they would rather build it themselves. So on the other hand, if the target is labor intensive, or say it has barriers of entry like a license, then it is difficult to replicate, and then the seller may have an upper hand. So when it comes to enterprise value for acquisition, there is not a single one size fits all approach. It would be based on several factors, such as what is the purpose of the deal, what is the context, what is the availability of data, preference, geographical presence of the buyer and the seller. So the valuation methods that are used for enterprise valuation are of course on the same lines that they are used for a normal business valuation exercise. We will take into consideration each of these approaches. So to begin with, say the target is a listed entity. So of course, one of the most important methods for valuation would be the market price method. Now, let's assume that we are acquiring equity shares from the existing promoters of the company. One would analyze market price. While analyzing market price, we would have to consider that because of, say, leaking of some data, or some temporary some order being achieved by the company, there is no temporary aberrations in the market price. Also, when computing the market price, one would have to consider that guidance is also given by the SEBI takeover code, which deals with in case of an acquisition or change in control, the acquirer would have to give an open offer, and that would in fact be based on, assuming the shares are frequently traded, it would be based on 60 days volume weighted average price of the company. So, of course, that becomes one of the most important parameters while determining the value under market price method. It also takes into consideration some of the other factors, like what is the price at which the acquirer is buying the company. Immediately before the main acquisition, has the acquirer acquired some other shares of the company in preceding 26 weeks or 52 weeks? At what price have those acquisitions been done? So all those factors would have to be analyzed when we are looking at the market price method. And market price method, especially when we are doing a valuation, may be more relevant when at the time of bidding, and the open offer would be relevant when the acquisition is already underway and what is the price at which it should be acquired from the public? Is what should be the offer price is the question. However, when we are looking at the decision making of whether the target is undervalued or overvalued and at what price should the target be acquired, a combination of approaches including the comparable companies multiple approach, the transactions in similar space, the discounted cash flow, and the requirement to replace or the cost approach, a combination of these approaches is what would be very, very relevant. So, if one were to look at the comparable companies' multiple method, as we all know, and as we've had sessions in the past on methods of valuation, we all are well aware that the typical multiples that could be used under the CCM method would be, say, enterprise value to EBITDA method, or the price to earnings method, or enterprise value to turnover method in loss-making companies as a crude benchmark, or in case of certain industry specific benchmarks, say like the mutual fund industry, it could be market cap to assets under management, or say for cement, it could be enterprise value to EV per ton. So it is basically based on the parameters where the other listed peers are trading. We will look at the adjustments required in each of these for each of these multiples or the discount rates separately as we move along. Similarly, for comparable transaction methods, the same multiples that I just mentioned under CCM can be used, and the similar adjustments would also have to be needed. One of the most important factors here would be to keep in mind the size, the timing of the deal. Okay. Income approach. This is one of the most important factors when a decision for acquisition is being made, the DCF method, because ultimately it all boils down to profits and the payback and the returns that the investment is generating. Of course, cost approach, as I mentioned, is important, especially if there are lower barriers to entry and it is easy to replicate the business. Then it is important to keep in mind that what exactly is that the company is proposing to acquire. Would it not be easier to just set up the new company rather than paying a premium for acquisition? Okay, so let's just deep dive into each of these methods. So we have the analysis. Okay. So to start with, once we have a target in mind, the first and foremost thing which all of us do in a normal valuation, and which should be done even in case of an acquisition, is to analyze the historical performance of the company. This would be a longer period, say 5 to 7 years of past performance, including the revenue growth, the EBITDA growth, the PAT growth, the requirement for funds, the working capital requirement. All of these would have to be analyzed. This is important because this analysis would help us understand whether the last year, the immediately preceding year, say for March 23, whether that is an adequate and a proper benchmark year, normalized year to consider for determining value of the target, or has it been an one-off year? It should not be that there was one particular order, a one-off order, which a conglomerate has given the target only because the conglomerate had certain internal issues in that year, and that order is not likely to continue going forward. In such a case, March 23 may not become the correct benchmark. So it is very important to closely look at the historical performance. And moving on from after historical performance, it would also be of utmost importance to look at what is the projected growth trajectory that the target is looking at. Is it that in the past, say it was growing it by say 20-30% year on year, and the next year it is estimating it will grow as 40%? What is the reason for that jump? Are some negotiations already underway, or is it merely that the numbers are overstated? or was it that there was an impact due to the COVID and it could not achieve the required growth? So it is very important to see what is the projected growth trajectory. And at that time, if say the company is in a high margin business with low barriers to entry, it would be important to also see that what is the period for which this benefit would continue. Would the other competitors not enter the space and eat up the pie, which is the normal way of working in an economy? So that is why one has to analyze the historical performance, the projected growth in the projections. Also, what is the funding and working capital requirement of the company? Is it that it is so capital intensive that usually the working capital is almost equivalent to the revenue? So the one has to give due cognizance to the working capital cycle of the company while determining the value. What is the capex requirement? Say, for example, currently the company is already functioning at 90% capacity, and that is the optimal capacity at which it can function. So, as an acquirer, you may be looking at, or one may be looking at synergy uh, because of expansion. So, but that synergy will not come in unless there is adequate capex incurred to beef up the capacity. So that is why the capex requirement also has to be looked at very closely. Moving to the next point, age of plant and machinery. Age of plant and machinery. Age of plant and machinery is also important because sometimes what happens is that one is looking. So this is the place where the operational DD team also of the company, which is usually the in-house team, would be very efficient because they would know, because they would, if they are from the same industry especially, they would know what typically is the age of the plant and machinery. And if the plant and machinery of the target are already, say the average age is 15 years and the plant has been already running for 13 years, then as an acquirer, one has to account for the fact that in 2 years, we are looking at a huge capex standing on the face. And then at that point, it should not come as a shock. Yeah. Okay. The long-term contracts due for renewal. So, and what are the major intangibles that are being acquired? These two, we could just take it up together. So, it is quite possible that, the target is catering to mainly one segment or one particular company. Now, what if the long-term contract with the conglomerate which it is providing services to is just coming to an end? So, it would be pertinent to analyze whether the long-term contract is due for renewal, how much is the customer concentration risk that the target is, running. Okay. Now, let's take some examples so that it's a little bit clearer. So this is a case where the acquiring company is a part of a big conglomerate and is engaged in the apparel manufacturing business. Company is engaged in the business since past 25 years and has developed strong relations with its stakeholders. Cash flows are stable with PAT margin around 15%. It proposes to acquire a private entity which is engaged in the business of selling footwear. It manufactures these footwear through contract manufacturing. This company, the footwear manufacturing company, has initiated its operations in 2013 through presence in tier 2 cities and has very few offline stores, and it has recently also started an online sales channel. And cash flows have been increasing steadily and the PAT margins vary from 5% to 7%. Now, in the projections of the target company has assumed that its PAT margins would eventually grow from 5% to say 5 to 7, which is the current range, to 15%. Now, what adjustments should be required for determination of cash flows of the target company? So now here, it is important to note that currently the margins of the company are at 5 to 7%. would it reach 15% on its own, or has it assumed that it would reach 15% once the acquirer acquires it? So that, and because of the benefit that acquirer brings on the table, that 5 to 7% becomes 15%. Because if that 15% of PAT margin is already captured in the target company's value, then, and if the acquirer, as an acquirer, then the acquirer is paying for what it itself is bringing on the table. So it is very important to segregate that what is it that the acquirer is bringing on the table and what is the value of the target on a going concern on an as is where is basis without support from the acquirer. So the target company's cash flows should not capture elements which shall be present only post acquisition. Okay. So there may be now here when we are looking at cash flows, we can also discuss that say for example this apparel manufacturing company has is say across pan India, and it has stores across in all malls and all tier 1, tier 2, tier 3 companies. So with the volume that the target company has assumed cannot also take into consideration that the volume of the that will increase because of leveraging on the distribution network and of the acquiring company. Similarly, even the cost, as the acquiring company would be a giant, it would have better negotiation power. Say it would also have the benefit of lower rents. So the target company cannot factor in these aspects in the cash flow when the valuation is being done for the purposes of acquisition. The target company's value has to be the base value. Coming to profits, what are the adjustments? We briefly discussed what are the cash flows should consider the cash flows of the target company without considering the benefits that the acquiring company brings to the table. What are the adjustments that are typically needed to profits? One-off income and expenses, which is the adjustment which we normally also do for non-recurring items of income and expenditure, non-recurring and non-operating. So those adjustments would have to be made even in case of a business acquisition. Remuneration not drawn. Now this is one very important factor, especially when the private company is a closely held promoter driven company. What happens is on those companies, though the promoters may be providing services and they may not be charging adequately for they may not be charging adequately to the company as or drawing adequate remuneration. So what may happen is that after acquisition, especially if the same team is being retained or if somebody else is being brought in to manage the business, that person would charge an adequate remuneration, say that is 3-4% of revenue, that effectively wipes off 3 to 4% of the PAT margin, which is a very important number. So it is important to analyze whether the remuneration that is taken into consideration in the projections is not excess or is not very low, and it is a fair remuneration that would be paid. Okay. Also, one has to keep in mind that are there any personal expenses which are debited to the P&L? This would especially would have to be mindful when we are looking at the provisional accounts for the purposes of valuation, and especially in case of smaller acquisitions. So we have to be cognizant of that. And one way to do it could be to benchmark the expenses with the expenses of its peers to know whether it is in the same range and to ensure that there is no overbooking or underbooking of expenses. Typically, when we are looking at acquisitions, it would be a case of underbooking of expenses, which would help increase the value. But we all know that we do come across cases where everybody is just above board, but they may have not incurred certain expenses and so they may have not booked it. or they may have incurred some extra expenses, so there is a lower margin of 1 year, but that is not the average. We also discussed on the historical growth. We would have to also keep in mind whether the historical growth is one time, or is it that growth is actually a sustainable growth. Okay. Moving on now, let's just take this company, this example first, risk transference. So now let's say again in the apparel manufacturing business, the conglomerate has a cost of equity of 10%, and the footwear business is a private company. What should be the discount rate? It is a private company, it is not listed. What should be the discount rate for discounting the for arriving at the value of the target company? Should it be 10%? Now, if the discount rate taken for target company is at 10%, then effectively we are transferring the lower risk of the acquiring company to the target company. So target company cannot be considered as safe as it is being acquired by a larger entity. While valuing for acquisition, one would have to value the target company as it stands independently on its own without the support of the acquiring company that is now coming into the picture. So the cost of equity of the target company should be basis the target company's risk exposure. Coming to the cost of borrowing. So, for example, now here in the same case for the footwear manufacturing business, say the agreed value, we have to arrive at the value, and the understanding is that the acquiring company currently does not have debt, but it can avail debt at say 8%, and so it will fund the uh, target company in an all cash deal, say with 80% debt and 20% cash. So, while arriving at value of the target company, would one take into consideration the interest rate of the acquiring company for the purposes of WACC computation? Okay. So the target company's debt equity ratio is 2:1 in this example, and it has an interest rate of 15% and a credit rating of BBB minus. The credit rating of the acquiring company is AA plus. Here, what would happen if one were to take the WACC of the acquiring company for the purpose, or rather only the interest of 8% while arriving at the value of the target company? Again, the same thing that we discussed in the cost of equity bit, that would be the same challenge if this is done while arriving at the value of the target company. So the manner of funding the target company should not determine its base value. That is, the benefit of 8% cost of debt is something that the acquirer is again bringing to the table. And it could be a part of the synergy benefits. But the target company, as it stands today, has a debt equity ratio of 2:1 and a cost of borrowing of 15%. These factors have to be taken into consideration while determining value of the target. The funding of the target company's business when the acquiring company should not influence the business decision, because if that is done, the acquiring company may end up paying a premium for the target company. So the acquiring company can have a different debt capacity, credit rating, ability to raise funds at lower rates, which the target company may or may not possess. If the target company is valued based on the acquiring company's ability, effectively, as we discussed, it's transfer of wealth from the acquiring company shareholders to that of the target company. The target company is to be valued based on its own cost of capital, its own ability to raise funds, its own debt equity mix. Okay. These are some of the other factors affecting the discount rates or multiples, which one has to take into consideration. One is diversification. The first one being diversification. So when we say diversification, it is important to note that especially when we are looking at multiples and we are looking at comparable companies and we are looking at the risk of the segment in which the target operates. If it operates in more than one business, it is important to consider the diversification, which may lower the risk of the target, and factor that in while so the discount rate may accordingly be lower or the multiple accordingly higher depending on the businesses in which it is diversified. The size of the target is also very important. Suppose our company as an acquirer has a price to earnings multiple of 15 and we are acquiring a target in the same business, exactly the same business. The apparel manufacturing is the business of the acquirer, and we are acquiring the target, which is also into apparel manufacturing business. But acquirer has a revenue of 10,000 crores and the target has a revenue of 100 crores. Would the two be comparable? Now, yes, the business of the two are comparable, but because of the difference in size, there are a lot of operational differences which would be present between the acquiring company and the target company. So it is important to accordingly factor this in the risk. So, and the growth potential. So accordingly, the multiple and the discount rate should again be adjusted. Business of the target, which goes without saying. Okay, customer concentration. What happens is sometimes large conglomerates, so say for example, for apparel manufacturing, for the major raw material, say for cotton, the apparel manufacturing business or which is the smaller target is relying on one particular seller and it sells the apparel only to that particular vendor. So, sorry, only to that particular customer of it. So, if tomorrow that customer has any operational issues or that customer stops its operation, there is a huge risk which the target carries because of the concentration of its customers, because say 80% of its revenue flows in from one particular customer. So accordingly, the discount rate should be higher or the multiple should be lower, because even when we are looking at the growth prospects, when there are multiple customers, we are looking at a larger basket and a larger there is a larger possibility for growth, whereas when we are looking at one customer, our business has higher volatility risk compared to, which is directly proportionate to how the customer performs. If customer comes under pricing pressure, the pressure will be passed on as a supplier to the target company also. So it is important to take customer concentration into consideration. Vendor concentration, this again would be on the same line. Competitive landscape. So it is very important to know that is the target in a very niche field, are there barriers to entry, or is it that tomorrow anybody can start that business and with quality and the correct type of contacts, then is it possible that there is a high threat to the business of the target that is proposed to be acquired? What is the leverage? If it is highly levered target that one is acquiring, of course, there is higher risk. One is looking at lower PAT margins in that case, and any fluctuations could result into further funding being required by the target. So leverage is also very important. Regulatory requirements, of course. Are there any regulatory requirements for maintaining a particular amount of funds in, say, shareholders account or policy holders account? So all those also become important factors. Non-compete. Now this is also very important. And while we deal with non-compete, it is also important to note that will the existing especially when a large conglomerate is acquiring a small business, how is the acquisition structured is also extremely important. Is it that the managerial team will they continue to have some skin in the game, maybe say hold 49% and have a staggered exit over next 4-5 years? Do they have a non-compete What if tomorrow they themselves start a competing business and the business of this company is lost? Is our track record relevant in this business? So these factors would be very important, and would have to be adjusted while carrying out a valuation for the purposes of acquisition. Tax benefits also, is it that the company is coming in with some tax losses which may be beneficial for the acquirer, and will those losses will in fact be available? In that case, it is something that the target is bringing into picture, and maybe it is a synergy which is arising because of the target having losses and the acquirer making profits. So what would be a relevant split between the two will also be a very important point. Intangible. So this intangibles are also very important point. So what may happen? Let's take an example. Suppose suppose there is uh, suppose there is a target company that uses which is a subsidiary of of a big conglomerate, and the conglomerate is looking to exit at that business. Now that say ABC, okay, let's say ABC is a very huge brand, and it's looking at just because of the brand, it has a lot of it has a lot of customer base, and it comes with a certain level of credibility. So some of its sales are also because of the brand name. Of course, it is one of the most important intangible assets. So when we are looking at acquisition for the purposes of acquisition, it would be and doing a valuation for that purpose. And while we are analyzing the projections, it will be important to analyze that where is this brand housed. Of course, as a small subsidiary of a big conglomerate, it is unlikely that the brand is housed in the subsidiary. It would be housed in the conglomerate or maybe promoters of the conglomerate. Is the company paying a royalty for the use of brand? If it is paying, is that royalty at a fair rate? What would be the impact? So would it be that today if my growth rate is say 20-30%, tomorrow that 20-30% would become 2 to 3% because the brand may not continue and the right to use the brand may not continue. And say today it is paying 1% because it's paying to its wholly owned parent. It's the holdco and it's a wholly owned subsidiary. So today maybe say it is paying only 1%. But is the fair charge 1% or is it 7%? What if later it has been decided that the subsidiary can continue using the brand, but it has to pay 7%? So that additional 5-6% is a drain on the business and should be adjusted while deriving value of the target. Also, in case of smaller companies, it is quite possible that the brand, though being used only by the target entity, is with the promoters and it is not housed in the company itself. So one has to be very clear as to, and they may not even charge royalty, but a consideration may have to be separately paid to the promoter for acquisition of brand. So it becomes very important to understand that where are the intangibles housed, how will they be transferred, and whether a fair charge for those intangibles is adequately captured in the business, and how will the business of the target be impacted because of such intangibles. This is also true for, okay, even for non-compete. What if tomorrow the promoters start a competing business? My customers are very comfortable with especially what happens in the smaller businesses. It is also driven to certain extent by the comfort with the promoters. What if the customers also move? So is there a non-compete in place? It's very important to understand that. And would the existing managerial team continue with the acquirer for a shorter period so that there is smooth hand holding? And would they have skin in the game? These are some factors which have to be considered while doing an valuation for the purposes of acquisition. moving on to synergies. Now, to identify both synergies and premium, one has to identify sources, quantify effects, access timing, and probability of realization, analyze historical premiums paid in similar transactions, consider growth opportunities, evaluate alternative, and balance the premium with returns and value creation for the shareholders. It is important to test the sensitivity and robustness of valuation to see how they change. Okay. Now, so first of all, when we are doing enterprise value for acquisition, the first thing that we do is arrive at a base valuation. Okay. The second thing that we do is, of course, if this is the base valuation, which is valuation of the target. This is valuation from the point of view of the acquirer, including the benefits that the acquirer may draw, and somewhere in between, including sharing of some of the synergy that both of them bring to the table, would be where the deal would take place. Only in such a case it would be a win-win situation. Because reports typically also state that globally, reports state that usually it is the target company shareholders who are benefited from the deal compared to the acquiring companies. Because, of course, on its own, the target company would be at a particular level. Plus, it gets share of the pie of being acquired. But it is important to know whether it's a seller's market or a buyer's market. That would also have a huge say. Okay. Now, coming to synergies, the synergies can broadly be classified into two categories: the operational synergies and financial synergies. Operational synergies leading to increase in operating income and growth of the business. This could be by using the distribution network of the acquirer, like in the case of footwear and apparel manufacturing. The entire footwear line can be placed in an existing unit of the acquirer across all stores. So this is something which is the operational synergy, greater bargain power due to the combined operations. Of course, this would result in higher margins, power to set industry standards, especially now. Here, one example which just comes to my mind is the merger of PVR and Inox. When these two giants merge, it would be important to it would it of course does that set industry standard, especially in terms of pricing. So leverage on diverse functional strengths of target company and acquiring company. It is possible that one is known for one is known for quality, while the other company is known for its uh, what do you say, service, and them coming together, then they can become an industry leader. So operational synergy is an important factor. In addition to operational synergies, there could be financial synergies. There could be ability to take higher debt because of combination of earnings, cash flow, possibility of repayment, possibility to avail funds at lesser rate, thus reducing the cost of debt, also tax saving. So with the operational synergy, say it becomes the market leader, has a large market share, the financial synergies would also flow in. Of course, these go somewhere hand in hand. There could also be tax savings due to exemptions, set off of losses, lowering of interest rates, etc. Cash project mismatch, combination of cash crunch but high return projects with cash surplus but limited project opportunity. There could be optimized resource allocation. Like you don't need to, for example, you don't need two business heads. You could have just one. So, a lot of cost saving in terms of that would also happen. So, how do we value synergy? So, to value synergy, what is done is we find what is the current valuation of the target company, what is current valuation of the acquiring company. We total them up and keep it aside. Then we also find out what is value of the combined firm, including the benefits that will arise because of synergy. The difference between the two is the value of the synergy. So when it is important to also note that the timing of synergy will also affect the business valuation. For example, if it is going to take 18 to 20 months to to streamline things, and if the benefits will flow in only after that, a present value would be important. So the earlier the synergy benefits, the higher the benefits of the merger, of course. So synergy is very important, and of course, the negotiated value could somewhere lie between the base value for the target plus some synergy. So depending on who has the bargaining power. Moving on to one other important factor of control premium. This question often pops up as to what is the control premium and when it should be levied. Now, in case, just give me a moment. Yeah. What is control premium and when should it be levied? Now, control premium, as the name suggests, is the premium that has to be paid for control, for obtaining a controlling stake in a company. So, with control, there comes the ability to manage or to make certain decisions, like the change in financing policy, the change in operational policies. So, the books say that value of control is typically greater when a company is not optimally managed. So the control is very subjective. Now let's say if one acquires a stake of 5%, one could say that there could be no control. But if say one acquires a stake of say 10%, a 10% stake typically comes with a board seat. So it does provide some element of control. Plus, exit, compulsory exit or squeezing out of minority under Companies Act would not be possible at a 10% stake. So there are certain powers also which come with that 10%. So there could be some element of control premium for a 10% stake. If we were to look at 25% or 26% stake, of course, there is again a control premium because there is a power to stop a special resolution in addition to the board seats. Further, if we are looking at, so sorry, just 1 second. Yeah. Yeah. So then say if we are looking at a stake of say 51%, of course, without saying it is substantial voting rights and a control premium may be payable. So this may demand a higher control premium. But if the stake control was say from 50 to 52 to 53%, that additional one premium may not demand control premium because the control is already with the acquirer. So the stake being transferred will also have a say on the control premium. What is the value of the value of control? It is value of firm under optimal control or as the acquirer perceives it minus status quo value of the firm. Again, there are rules of there cannot be a single rule of thumb here. There are certain reports and articles which suggest that typically this is in the range of 15 to 25%. But then again, the control premium would depend on case to case, and the stake of holding the circumstances in which the acquisition is being done would become an important consideration to determine what should be the quantum of control premium. Some additional considerations. Depending on business of the target, the regulators of the aforesaid businesses may have specific restrictions of change in control. There may be trade-off with respect to change in control, like no Section 79 of the Income Tax Act, like no tax benefit of stakeholders of combined entity undergo a change in case it is not a company, which is a company in which public are substantially interested. Relationship of existing management with business stakeholders may cause resistance for change in control. So this is especially important when it is a case of a hostile takeover. Company charters may have laid down elaborate procedures for avoiding change in control. Control premium should also account for ease with which managerial changes can be effected. So it is a very important consideration and should be backed up as to how the control premium has been decided. Okay. So we have looked at the value of the base entity, what adjustment should be made to profits and to the discount rates and cash flows. What should be the value of synergy and the control premium that could be used to, and then accordingly based on negotiations, what is the value and whether, so especially when the advisory is being done or evaluation is being done to make a corporate budgeting decision, corporate finance decision, it is important to look at it from that state of mind as to what should be the ideal value for acquisition, what should be the make or break value for acquisition. Some other key factors which should be borne in mind are here. So, like the internal rate of return or the IRR, as we typically call it, we all know that IRR is basically the rate at which all the future cash, the rate at which, basically the rate of return at which all the future years cash flow, if discounted, gives the investment value. So effectively the year-on-year return that we are coming to. So as a company, there could be some specific thresholds given the risk that, say for example, at an IRR of say only 9 to 10%, one would, or say 5 to 6%, one would rather invest in an FD and just earn interest rather than to take up the risk and, run an entire business and then get only 5 to 6% as a rate of return. So from that that frame of mind, it is important to analyze what is the internal rate of return that we are looking at. The payback period, as the name suggests and as we know, is the period over which one will recoup the investment. It is important to study what is the payback period because the longer the payback period, the riskier the investment, and it may not be it may become less and less lucrative as the payback period increases. Impact on EPS. This is especially important in case of traded shares because it would affect the combined market price of the entity. Maybe not immediately, but going forward effectively that what is the EPS of the company. So impact on EPS again is an important factor to analyze while carrying out an enterprise value for acquisition. Sensitivity and scenario analysis. We touched upon this briefly in the past. Now, what is sensitivity and scenario analysis? We have to see, say for example, the discount rate that we are coming to is say 12% for the business, and according to us, the growth rate should be around 5 to 6% in the terminal year. But that is at that particular level. It would be important to see that what would be the value of the business if from 12% it would suppose to the discount rate was say 15%, and instead of 5% of terminal year growth, the business only grows at 3%. What would be the value in that case? And also, while this is a sensitivity to the base parameters that are being used for valuation, similarly even for the multiples, scenario analysis would be that what would be the case in case one of its major customers discontinued the business? What is it? How by how much? What is the quantum by which the value of the business would be affected? So the sensitivity and scenario analysis are a must in an enterprise value for acquisition. Data tables could obviously be used for sensitivity and scenario analysis and to make a very informed decision. Okay. Coming to common pitfalls in acquisition valuation. Now, these are, I could say, more than pitfalls. One has to ensure that these are properly given effect to in the valuation working. Firstly, the differential shareholding valuation. For example, now the target company has substantial ESOPs. So, and it is a case of merger. Upon merger, the acquirer will also have to issue ESOPs. So, it is important to here analyze that what is the quantum of dilution that one is expecting because of these ESOPs. Is it that the acquirer does not have an ESOP scheme in place and only the target has an ESOP scheme in place, and to come at a balance, the acquirer would also have to come up with an ESOP scheme. So, and accordingly, adjustments would have to be made to the business enterprise value on acquisition. Then, do all the shares have voting rights, or there are certain shares with differential voting rights? Are there any convertible securities lying with the company, which could result in lack of control or dilution going forward? So these factors would have to be seen very closely. Are there any securities with vested right? And in case it is a private company, is there any ROFR or tag along right or drag along right? So, for example, if we are looking at acquiring only say the target has investments from certain public shareholders, though it is not listed, and say the promoter holds 70% and the other shareholders hold 30%. We are proposing to acquire the target, say 60% shareholding. So what may happen in case of tag along rights? What may happen is that the other minority shareholders of the target would have a right to exit along with the promoters. So eventually, what the scenario we are looking at is that 30% of the minority exists out of 70% of the promoters. 30% of the promoters exist, and 40% stake, or 40% stake continues to be with the promoter. So effectively, rather than a complete acquisition, we are more looking like at a joint venture scenario with the acquirer holding 60%, which may drastically change things. So even from a decision-making perspective, and this could affect the way the synergy has been considered in the value, the control premium, and even the cost reduction strategies and everything. So it becomes important to give effect to these finer points in the valuation for an acquisition. One most important factor for acquisition. So acquisition is the date of acquisition. So it is possible. Now, suppose we are valuing the business today, but the business transfer agreement says that because say it requires some regulatory approvals, it is possible that the business, though the agreement is signed today, would be transferred from say 30th of September or 1st of October. Now, what would happen if the target company's requirement of working capital is 80 crores, but business is transferred only with 20 crores of working capital? So that 60 crores would be a loss to the acquirer. So effectively, as we know, these clauses for the closing date, closing adjustments, or the closing date working capital are always mentioned in the share transfer agreement or the business transfer agreement. So it is important to note that now we are doing a valuation today based on say 1st August balance sheet, and right now the working capital is at 50 crores. So it is important here to understand that what is the level of working capital which will be transferred, which is based on the agreement between two entities, and the business value for acquisition has to adequately take that into consideration so that there is no delta. Okay. Pitfalls, going forward to some other adjustments, which also would require, careful scrutiny, bias sampling, as the name suggests. If we are looking at especially comparable transactions, acquisition price, which is justified from databases comparable companies, we have to ensure that there is no subjective bias and the result that we see is not distorted because we want to arrive at a particular value and we think that is a particular value. So preferably there should be a pool of companies which should be identified, and one doesn't have to select a multiple. It has to be, one would have to see the average, the mean, the variance between the various multiples, and then arrive at a proper multiple which may be relevant for the company. Similarly for beta for the risk. Objective evaluation of additional premiums demanded by target company. The target company stakeholder may intend to believe that they are receiving less than what the target company is worth. they may demand unnecessary premiums to be adjusted, like towards brand, patents, and sometimes these may not be housed in the company. And in fact, the legal ownership of them may not be transferred. So, as we discussed, it is important to evaluate those factors. Now, when we talk of acquisitions, we know that startups are being acquired and are being invested in globally, and things are moving very fast, especially with the presence of AI. So, let's look at some difficulties which are specifically present in case of a startup valuation. Now, a startup valuation differs significantly from traditional business because traditional business will have some historical data, it will have some precedence, and like especially in case of brick and mortar business, how it is expected to grow. The business models are well established, whereas in case of startups, the business models could differ significantly. The profitability could change significantly. The scalability is, the scalability could be very different. It could be scalable, it could scale up in 2 years, it could take 15 years. The funding profile on how it receives funds, when it receives funds, compared to an established company which comes from a strong promoter backing. So these are some difficult calls. So they cannot be valued like traditional businesses like the apparel manufacturer or a steel producer. So typically, startup valuation is an approximation and can yield a relative number. And that is why we've seen that in the last year, the multiples that the startup valuations have also been drawing have also come down. So there is the difficulties in startup valuation would mainly be because of limited historical information, limited comparable companies to benchmark transaction. These are not publicly traded. So the risk profile is different. Existing assets are a very small proportion of the overall business. One second, I think my screen sharing stopped. Is my screen visible?
Yes, ma'am.
Okay. Okay. There are some other relevant issues as well with the enterprise value on acquisition. While valuation is done for the purposes of acquisition, and especially on an advisory front, it is important to also analyze and see whether a purchase price allocation would be required, because a purchase price allocation, as the name suggests, is allocation of the consideration over the various tangible and intangible assets acquired. Now, under the Ind AS framework, other than companies which are under common control or where the control is transitory, the acquisition date fair values have to be used for the tangible and intangible assets. So it becomes important to just note that what is going to be the impact on the profit and loss account, and this is especially for advisory, that and how would that affect the value. So, say for example, we are recognizing 50% of the purchase consideration as one major intangible. What is the likelihood of impairment being tested and it being debited to the P&L in the next year? And how would that affect the market price, or even if not the market price, say the net worth criteria required by the company to be maintained? So, some of these factors would also contribute to what is the hurdle rate for an acquisition. So that is why a purchase price allocation should also be kept in mind. Tax, I think we already discussed tax. Say, for example, Section 79, or in case of demergers also, what are the tax benefits and losses that are being transferred with? Will a tax exemption continue? Would it be lost? Could there be certain demands because of a decision being made? So these also would be important considerations. What is the time frame for the acquisition? The time frame for the acquisition will also be important. Are we looking at 1 year or 2 year period? Typically, if we are looking at an NCLT process, and especially in case of listed companies, we are looking at a longer period, before the acquisition is given effect to. So it becomes important to keep that in mind, that all the benefits that would flow in would only be after that period. And it should not happen that in that period, the quality of assets significantly deteriorates, though it may be that in the intervening period, the business is carried out in trust, but the quality of assets should not deteriorate in that time frame till the acquisition is underway and it has not yet completed. So that also becomes a very important issue to be borne in mind. No. Coming to consideration. Now, consideration is basically the consideration can be discharged in various ways on acquisition of target. It could be by way of issue of shares. It could be in cash. It could be partly in debt and partly in shares. So effectively in cash, it could be conversion of loan into equity shares. So this also should be given effect to, especially from a risk standpoint. And so what certain reports and books suggest is that the most efficient way that listed companies find and think is, to give consideration in form of its own stocks, because by that way they are not reducing their value by paying out consideration in cash, and they are issuing stock and increasing the value of the combined business. There is no cash outflow as such, only the equity shares are going up, so there is no outflow from the business, and so the enterprise value of the business has gone up, though the per share on a per share value basis it could be the same. So consideration is also an important factor. So especially if the transaction is being done in say like a slump transfer for equity shares, or a slump or a merger or a demerger where shareholder of shares of the transfer or transferee are being issued as consideration. So the shares of the transferee would also have to be valued at fair value. We'll just take it up after 1 or 2 slides, especially, or I think we can discuss right now. So, okay, especially in case of listed companies, when there is a merger of a private company into a listed company, to safeguard the interest of the public shareholders, SEBI has in their ICDR regulations specified that the value of the listed company cannot be considered as lower than the value of 60 days VWAP, higher of 90 days VWAP or 10 days VWAP. So VWAP is the volume weighted average price. So the higher of those two price has to be seen, compared it with the fair value that the valuer has arrived at, and the higher of those two values is the value that has to be taken for consideration. This is SEBI's mechanism for protecting the shareholders of the acquiring entity, especially in cases where the target is not listed. Okay. So when the target is listed, we already discussed that there could be open offer. If the target is listed and the acquirer is not listed and shares are being acquired from the promoters of the target, the open offer code of SEBI would be triggered, and an open offer public announcement will have to be made, and an open offer will be made pursuant to the public announcement. There could be some control premium which would be built in. SEBI has laid down various parameters which we discussed in the start. Based on 60 days market VWAP, or in case of infrequently traded stocks, based on fair valuation plus the price at which shares have been acquired by the acquirer in previous few weeks, so say 26 weeks or 52 weeks, and so those 5-6 parameters would have to be analyzed to arrive at the base price, and that would have to be kept in mind, because listed shareholders, the public shareholders are involved. Okay. If the acquirer is listed, we just discussed the ICDR. If the acquirer is listed and the target is not listed, ICDR pricing would kick in for the acquirer when the consideration is being issued in stocks of the acquirer. And in case both are listed, the target as well as the acquirer, it would, and it is a case of a merger, it would, and it follows the NCLT rule, it could be at fair value, which could be based on a combination of different approaches. Yeah. So, certain key regulations. Now, companies, in terms of value on acquisition, now Companies Act, if the acquisition is by way of preferential allotment, if majority shares or securities, convertible share securities, quasi-equity is being issued to the shareholders, cognizance would have to be given to Section 62 of the Companies Act and 42 for in case of private placement is relevant. And the value cannot be lower than the value determined by a registered valuer. A registered valuer report also would be needed. In case of SEBI, and under the Companies Act, if it is a related party transaction under Section 188, like if the entity business is being acquired from a related party, an audit committee approval would be needed. And in certain cases, in case the transaction is material, like more than 10% of the net worth or turnover, a special resolution from the shareholders would also be needed. Now, in case of audit committee approval, only the independent directors shall be allowed to vote. So the related party cannot vote in those meetings. Okay. And if the entity is listed, then SEBI ICDR regulations also kick in, where it requires that the preferential allotment should not be at a value which is lower than 90 days, lower than higher of the 90 days VWAP and the 10 days VWAP. So one has to compare the 90 days VWAP, 10 days VWAP, find out which is higher, and the preferential allotment cannot be at a value lower than that average market price. That average market price, in case the articles of association also specify that preferential allotment shall not be at less than the fair value, the article, then a registered valuer report would also be needed. And in case there is a change in control by more than 5%, or shares are being issued to a person for more than 5%, or if there is a change in control, the valuation report by a registered valuer also has to give guidance on the control premium. Okay. Securities and Exchange Board of India takeover regulation. This is basically the takeover regulation that we discussed in the past also. And the SEBI LODR regulations, these would kick in especially in case of related party transaction. And in case of a material related party transactions, this would also require approval from the shareholders of the listed company. And this will require majority voting by the public shareholders. So the related party shall not be allowed to vote for such resolution. So this is the regulatory framework which protects the minority shareholders basically. Yeah, this is just a bibliography of, because of course, reference has been, taken from for some things from the books and guidance by Professor Ashwath Damodaran, and also from the book of McKinsey, as well as certain news clippings and certain other websites. Okay. So, thank you for hearing me. We can take up any questions. Anisa, if required.
Yes, ma'am. Before we start the question and answer session, I request all the participants to fill the feedback form as link is shown on their website screen. So, ma'am, shall I start with the question and answers?
Sure.
Other questions? Yeah. What is the premium that can be paid for synergy?
So, as we discussed, this is a very subjective element. There cannot be a fixed premium which can be paid, it is not that it can be 10% or 15%. It has to be determined on a case to case basis. One would have to see that what is the value of the target firm without synergy. What would be the value of the target firm with synergy, and including the synergy that the acquirer is obtaining. And the difference between the benefit can be split between the acquirer and the target, basis the negotiation power and who is bringing more to the table. So there is no standard percentage which can be used, but it would be based on evaluation of each of the case.
Okay. The next question is, can we accept a debt equity of 4:1 for merged entity? Post merger, high debt is due to funding the acquisition.
In this question, we are valuing the company for the purposes of acquisition. So we would be valuing on a pre-merger, pre-acquisition basis. And if that debt is being taken for the purposes of acquisition, and that 4:1 ratio that is mentioned, according to me, has to be seen from the point of view of the acquirer and not from the point of view of the target.
The next question is discounted cash flow need to be considered for payback calculation?
Yes, discounted cash flow, because that is the only way that we would be able to, work out the payback period as to what is the cash flow that is, what is the present value of the cash flow, and in how much period are we recouping the investment. So one would have to look at the cash flows.
How does the inclusion of debt, cash, and other financial instruments in the calculation of enterprise value affect the valuation of target company?
So, debt would of course go on to reduce the value of the target company. Cash would go to increase the value of the target company. And for other financial instruments, it would really depend on what is the nature of the instruments. Are there any call or put options attached to those instruments? And so, say for example, if we are looking at optionally convertible debentures, one would actually have to analyze as to what is the likelihood of those debentures being converted into equity or it being redeemed, and accordingly, the treatment would have to be given while valuing the target. So that analysis would be needed.
The next question is, in what scenarios might a company be willing to pay a premium to be calculated enterprise value for an acquisition?
So there could be several factors when they might be willing to pay a premium. So this is not drawn from the motives. So if control or say for example, if there is a barrier to entry. Now, say for example, a bank wants to acquire a broking license, and the Reserve Bank of India, for some reason, has stopped or has decided not to grant any further broking licenses to a new broker. And if one bank wants to grow in that space, it may require that some premium be paid for that broking license. Or if it helps the business enter into a completely new field, or if they see that there is significant synergy, then a higher premium may be justified for the acquisition. So it depends on whether it is a buyer's market or seller's market.
For startup valuation, should we just take the projections at the face value as provided by the founder?
No. No, a detailed analysis would be needed, because most of the startup valuations are more like a story, more based on the story. So while as a valuer, we may not be well equipped to make projections for the startup, but at least we would have to deep dive into it and figure out as to whether what is being projected and what is being estimated, is it achievable, and what is the risk or probability that we see for their achievement, and accordingly take the discounts, and also see that how are similar startups being valued and what are the comparable transactions at. So yeah, that risk is always there in case of a startup valuation. And especially in startups, what we can also see is if there has been an immediately previous round, which is just prior to this acquisition, at what value was that? And after that round, has the performance increased or has it dipped? So those things can be seen together to determine the value for startups.
How do fluctuations in interest rates impact the enterprise value of an acquisition, particularly when debt is involved?
So, with an increase in interest rate, so if a company is highly levered, it would be, it could be a very risky acquisition. So, with increase in interest rate, what would happen is when we are unlevering the cost of equity, the cost of equity or the risk attached to the equity shareholders also goes up. And while the weight of debt is higher, the cost of equity would also go up, and the overall weighted average cost of capital should be a bit higher than at a normalized level.
When analyzing an acquisition, how might the assessment of a target company's non-operating assets and liabilities affect the final enterprise value?
So, in case of non-operating, say for example, there is a vacant land parcel which is also being transferred, and that is non-operating, and say it is not related also to business. Okay, so let's divide this non-operating asset into two parts, that it is non-operating and not related to the business. Say for example, it is a flat and it is not operating currently, but it is related to business and can be used for expansion. So if it is non-operating and is not used for business, say for example a flat, that has to be taken at fair value and it would simply be added to the enterprise value, because that is also an asset that is being acquired. Whereas if we are looking at, say, an adjacent land on which an expansion is possible or an expansion is underway, and we already have orders on hand, and there would be expansion is immediately possible on that adjacent land after incurring some minimal capex, we can consider the capex outflow and the revenue that additional plot of land would bring to the table after appropriate discounting because of risk, and take that as a part of value.
Next question is, what potential pitfalls should companies be aware of when relying solely on enterprise value as valuation metric for acquisition? I think you have covered this in detail. You have covered already this during the presentation. Who starts demand for control premium, acquirer or target company promoters?
Of course, ideally it would be the target company. The acquirer would like to get the best deal for its stakeholders. So it would be the target company which should ideally start, in my view, the demand for control premium.
Now, ma'am, these were the questions received by us. So it was a very wonderful session, giving thorough insight of the valuation with respect to acquisitions. It was a very excellent delivery, supported by a very good presentation and examples. And I'm sure it will have benefited all the participants. Further, all the queries of the participants were instantly addressed by you, and hope must have been to the satisfaction of all the participants. With this, I present a hearty vote of thanks on behalf of the team of Valuation Standard Boards of ICAI and all the participants. Thank you, madam.
Thank you. Thank you.
Have a great day.
You too. Thank you.
With this, we come to an end to the session. Thank you.
Thank you, ma'am.